Hello everyone, welcome to our YouTube channel, it's Alex. What if your money could work harder than you do? What if it could multiply without you lifting a finger? Welcome to the world of investments, where your money does the heavy lifting. Investing is like planting a seed today and watching it grow into a mighty tree over time. It's a key strategy for financial growth and wealth accumulation. Now you might be wondering, where do I start? There are a myriad of investment strategies out there. But today, we're going to focus on the top 5 strategies that are particularly beneficial for beginners. These include the power of diversification, the magic of compound interest, the long-term game, the regular investment approach, and balancing risk and reward. Each of these strategies has its own merits and demerits, and understanding them can be the difference between financial growth and stagnation. So, fasten your seatbelts and open your minds as we delve into the world of investing. Stay tuned as we explore the top 5 investment strategies that can help you grow your wealth. Ever heard the saying, don't put all your eggs in one basket? That's exactly what diversification is about. In the realm of investing, diversification is a magical word. It's a strategy that involves spreading your investments across various types of assets: stocks, bonds, commodities, real estate, you name it. The goal? To minimize risk. See, not all investment types perform well at the same time. When one sector lags, another might soar. By having a foot in multiple doors, you can guard against the unexpected and keep potential losses to a minimum. Think of it as a safety net. If you were a trapeze artist, wouldn't you want one? The same principle applies here. Diversification doesn't guarantee you won't lose money, but it does provide a cushion that can soften the landing. So whether you're a seasoned investor or just getting started, diversification is a key tool in your toolbox. Remember, a well-diversified portfolio can be your safety net in volatile times. Scene script. Imagine planting a seed today and watching it grow into a money tree tomorrow. That's the magic of compound interest. Let's delve into this enchanting world of compound interest. It's like a snowball rolling down a hill, getting bigger and faster with each turn. Here's how it works. You invest a sum of money, and it earns interest. Instead of pocketing that interest, you reinvest it. Now, your original investment and the interest it earned both start earning more interest. This cycle continues, and your money grows exponentially over time. Imagine you invest $100, and it grows by 10% each year. After the first year, you'll have $110. If you reinvest that, the next year, you'll have $121. The following year, $133. You see, the growth isn't linear, it's exponential. The sooner you start, the more time your money has to grow. That's the power of compound interest. In the world of investments, patience isn't just a virtue, it's a strategy. Long-term investing is about more than just waiting out the storm. It's about understanding that the real value of an investment comes from its growth over time, not its immediate returns. There's a certain beauty to the long-term game. It's like planting a seed and watching it grow into a towering tree. You don't need to worry about the daily ups and downs of the market, because your eyes are set on the horizon. By staying invested for a longer period, you give your investments the chance to compound and grow exponentially. It's like riding a wave. Sure, there may be dips and rises, but ultimately you're moving forward. Remember, Rome wasn't built in a day. It takes time for wealth to accumulate. So, don't get swayed by short-term fluctuations. Keep your eyes on the prize and let time do its magic. In the investment world, it's the patient who reaps the biggest rewards. Consistency can be a superpower, especially when it comes to investing. Now let's talk about a strategy that embodies this principle: the regular investment approach, also known as dollar-cost averaging. Imagine you've decided to invest a fixed amount of money every month. It doesn't matter if the market is soaring high or sinking low, you stick to your plan. This is the essence of regular investing. But why is this approach so powerful? Well, when the market is down, your fixed investment buys more shares. And when the market is up, you buy fewer shares. This means you're buying more shares when prices are low and fewer when they're high. Over time, this can lead to a lower average cost per share than if you were trying to time the market. This strategy is not about making a quick buck. It's about patience, discipline, and the power of consistency. It takes advantage of market fluctuations and reduces the risk of making poor investment decisions based on short-term market conditions. But remember, like any investment strategy, regular investing doesn't guarantee a profit or protect against loss in a declining market. It's essential to consider your financial situation and risk tolerance before deciding on a strategy. So, keep investing regularly. Over time, your small contributions can add up to a large sum. This is the magic of the regular investment approach. It's a steady and disciplined way to build wealth over the long term. Consistency in this case truly is a superpower. No risk, no reward, not necessarily. In investing, it's all about balancing risk and reward. Imagine walking a tightrope. On one side, you've got potential profits, on the other, possible losses. The key to successfully navigating this financial high-wire act? Understanding your own risk tolerance. Risk tolerance is a personal thing. It's about how much financial uncertainty you can stomach. Are you the type who can ride out the market's ups and downs without breaking a sweat? Or do you prefer a more stable, predictable path? These are crucial questions to answer before you start investing. Once you've figured out your risk tolerance, it's time to align it with your investment choices. High-risk investments like stocks have the potential for high rewards, but also significant losses. On the other hand, low-risk investments such as bonds or money market accounts offer more stability, but usually with lower returns. The beauty of investing is that there's no one-size-fits-all approach. You can tailor your portfolio to suit your individual risk tolerance. Mix and match high and low-risk investments. Balance out the potential for high returns with the security of steady, albeit lower, gains. That's the essence of a balanced investment strategy. Remember, investing isn't about taking the biggest risks, but about making the smartest decisions. It's about understanding your own financial goals and comfort zones and choosing investments that align with them. So, step onto that financial tightrope with confidence. After all, it's your money and your future at stake.